Introduction to the risk of death and its financial impact. The risk of death is an unavoidable part of life, and it carries significant implications for a person's estate and their surviving family. This chapter explores the financial consequences of death and how risk management strategies can be applied to address them. Some people may avoid thinking about their own death or consider it too far in the future to worry about. However, everyone is constantly exposed to the risk of death, which is a very real concern that needs to be addressed. In insurance, the probability of dying at a specific age is known as the mortality rate. Many factors influence an individual's risk of death, including their age, gender, family history, health, smoking status, and even their job and income level. Life insurance companies group people with similar risk profiles and use historical mortality data to estimate an individual's risk of death. Introduction to the risk of death and its financial impact. The risk of death is an unavoidable part of life, and it carries significant implications for a person's estate and their surviving family. This chapter explores the financial consequences of death and how risk management strategies can be applied to address them. Some people may avoid thinking about their own death or consider it too far in the future to worry about. However, everyone is constantly exposed to the risk of death, which is a very real concern that needs to be addressed. In insurance, the probability of dying at a specific age is known as the mortality rate. Many factors influence an individual's risk of death, including their age, gender, family history, health, smoking status, and even their job and income level. Life insurance companies group people with similar risk profiles and use historical mortality data to estimate an individual's risk of death. Two ways of looking at the risk of death. There are two primary ways to view the risk of death: life expectancy and probability of death. Life expectancy. This is the average number of years a person in a specific group and of a certain age can be expected to live from that point forward. For example, according to data from Statistics Canada, the median Canadian male who is 65 years old is expected to live another 19.5 years. This means that 50% of men currently aged 65 will live to be 84.5 or older, while the other 50% will die before that age. An agent may focus on life expectancy when helping a client with a retirement savings or income plan, as it helps determine the appropriate planning horizon. Probability of death. This is the statistical probability that a person in a defined group and of a certain age will die before their next birthday. The same Statistics Canada study shows that out of every 100 Canadian men who just turned 65, 1.103 will die before they reach their 66th birthday, a probability of death of 1.103%. An agent may use this information to help clients understand that the risk of death is real and needs to be addressed when conducting a life insurance needs analysis. Mortality statistics are often presented in a life table, also known as a mortality table. A person's probability of death is low in their early years, except for the very first few years of life, and increases slowly until about age 40. After age 40, the probability of death increases more dramatically each year due to age-related health issues like cardiovascular disease. A female's risk of death is lower than a male's at the same age, which is why gender influences life insurance premiums. Potential financial impacts of death. The financial consequences of death can be devastating and are a key consideration when a life insurance agent works with a client. Loss of income. The death of an income earner can have a devastating financial impact, especially for a young family that relies on that income. Loss of a caregiver. The death of a non-income earner can also significantly impact a family's finances, particularly if they were the primary caregiver for children or other dependents. The surviving spouse may need to hire someone to take over the caregiver role, which can be expensive. Debt repayment. When a person dies, the estate's executor is responsible for paying off all outstanding debts, including mortgages, car loans, and credit card debt. If the surviving beneficiary can't get the loan extended to them and the lender demands payment in full, the executor might have to sell the property to pay off the debt. Income taxes. The income tax liability that arises upon death can seriously erode an estate. When a person dies, they are deemed to have sold all their property at fair market value, which can trigger a taxable capital gain. If the estate doesn't have enough money to pay the taxes, the executor may have to sell assets intended for the beneficiaries. Registered assets, like an RRSP or RRIF, are also deregistered upon death unless a rollover applies, meaning the full amount is taxed at the person's marginal tax rate. Estate creation. Some people want to leave a financial legacy to their loved ones or to a favorite charity. This could be to fund their children's education, provide a lump sum to help them buy a house or start a business, or make a significant donation to a charitable cause. Business impacts. The death of a key employee or shareholder can have a severe impact on a business, sometimes even leading to its collapse. For example, when a successful restaurant's key chef died, The business experienced a dramatic drop in revenue and faced financial strain that almost led to bankruptcy. Risk management strategies. Regardless of the type of risk, there are 4 general strategies to consider. Risk avoidance. This involves deciding not to expose oneself to the risk in the first place. For example, a person could avoid the risk of a car accident by not driving. However, it is impossible to avoid the risk of death simply by living. Risk reduction. If a risk can't be avoided, it may be possible to take actions that reduce its probability or severity. A person can reduce their risk of death by living a healthy lifestyle and avoiding hazardous activities. While this won't eliminate the risk entirely, it can reduce the probability of a premature death. Risk retention. This strategy means a person accepts a risk and is willing to face the consequences if it's realized. It is most appropriate for risks with a low, manageable financial impact. Since the risk of death is considered a high-severity risk with a significant financial impact, most people don't have the financial resources to retain this risk. Risk transfer. This strategy involves finding someone else to assume the consequences if a risk is realized. Insurance is a risk transfer strategy that addresses the risk of death. By paying premiums, a person can transfer the possibility of a financial catastrophe to an insurance company. Insurance is also known as risk sharing because it spreads the financial losses of the few who experience an insured event among the many who are insured against that event.